Right, so let me recap a little bit on the statement of profit and loss here from the work that was done. Right, statement of profit, right, and loss and other comprehensive income. Right, so there is a difference in how we compile the statement from the previous level. So the statement of profit and loss comes with the following. Right, so is made up of the following. Right, so there is the actual P&L, the P&L account. So you get the statement of profit and loss itself. Right, this particular statement of profit and loss is summarized. Right, meaning to say you don't disclose all the information concerning all the income and expenses. Right, so this is a summarized statement, right, including selected, right, including selected balances of income and expenses. So remember, in your other level, in level 1 in accounting, when you are doing the statement of profit and loss, you were expected to highlight every income, every expense. So you will see on the body of your answer, you will have repairs and maintenance, you will have rent expense, you will have all other expenses, you will list them. If you had a list of 20 items, you will list all of them. Right. However, at this level, that is not required. You summarize so that your users of financial statements can get the highlight of the financial statements and are able to pick up the important information. Right. So if you go to the work that we did in the previous week, you will see that we have got a structure that we'd already compiled here. You're right. We'd already populated as well. So your statement must have revenue. Right. Remember, revenue encompasses a number of things in its calculation. For example, you can see that we've got two figures. Now, revenue basically is your sales, right? Then you less any sales returns, you less any settlement discount, right? On the face of the statement, you don't have to show the different items like the sales, the settlement discount, and the sales returns. You calculate that on the side. If it is possible, you have calculations and then you put the final figure there. If, however, the calculation is not very long and can fit in one line, you can do what we did here, which is just to show the what? The calculation there. Right? And then you have also the cost of sales. Right? We all know that the cost of sales calculation is opening inventory, add purchases, less closing inventory, and then we get cost of sales. You do that calculation on the side. Here, we just want to see the total. In this question that we're having, that calculation was given slightly. You didn't have to calculate the whole thing. I'll show you when we go to the question. You must show the gross profit, right, which is the difference between revenue and cost of sales. You must show other income. Now, again, other income is made up of many things. It could be rent income, right? It could be profit on sale of assets, fair value gain, right? You don't show those things line by line. You calculate on the side and then you show a combined figure. Right. And then in terms of expenses, what you do, you go to a question. I'll show you an example. If we go to our example that we're doing here, which is a question somewhere in your study guide, I think it's called Corporate Limited. Right. You go to the structure of the trial balance. So you will see the highlight of the expenses that they want. Now, if you check nicely, you are not given the repairs and maintenance. You are not given the different types of expenses one by one. But you can see that they've got a subtotal here of other expenses. It includes depreciation plus other expenses that have not been highlighted. Right, you have got administration expenses. There are many items that make up admin expenses. Salaries of accounting staff, salaries of the managing director, rent for the admin building, all of that makes up admin expenses. Right, they've got distribution costs. Again, there are plenty here. Fuel for delivery vehicles, advertising, and similar expenses. So you can see that this is not a name for a particular expense. These are subheadings. Certain expenses grouped under a certain classification. So what you do, you go and check the question, because it's not always that they are going to give you these three. Sometimes they may give you a different description altogether. But by looking at the question, you can identify the different classes of expenses that they want you to disclose. Then when we go to the question like this, you see now I've got other expenses, I've got admin, I've got distribution. I won't be disclosing each type of expenditure in each classification there. Right? You always must have the finance cost on its own. If you incurred any financial expenses, those must go in a separate line. Then you are able to calculate profit and loss, right? You put your income tax, profit for the year, and then you have other comprehensive income. We're going to discuss what goes in there. And then you have your total comprehensive income. So this is a typical structure at this level, which will differ slightly from what you did, because there you were not grouping expenses under classes. Each expense was being shown on its own. So that's the first thing that you must note. That is different when you do the statement at this level. Now, the statement then comes with what we call disclosure notes. But the statement then comes with disclosure notes. Now, remember the top part there, which is the P&L, we were summarizing. Right. However, we are saying that some users of the financial statements, right, may need to get finer details of the information contained in the P&L. Right. For example, someone may want to know what makes up the other income. So you need a note now that can give that kind of information to a curious user of the financial statements who wants to see the finer details of what makes up figures that you have disclosed in your statement. So you need to show the disclosure note. Right here, we show two notes. We have what we call the profit before tax note. Right, so we need to show the profit before tax note. Right, and number two, we need to have the director fees note. Right, so these are the two notes that are going to accompany our financial statement. So therefore, when you say I am done compiling the profit and loss, it must come with the P&L. Right, in addition to that, it must have these particular notes. I'll come back to the notes and explain what you put in the notes when we cover that part in the question that we are doing. Right, so that's a summary of what the statement of profit and loss should actually contain. Any questions, good people from the floor? Right, are we clear? Yes, Mr. Bruce, you can go ahead.
Yes, sir.
Yes, thank you for giving me the opportunity to ask. I don't know, with the new IFRS, is it 18? I don't know how you're going to structure that example that you have, because now they say we have to split into operating, and then there's financing as well as the other one. I don't know how you're going to include that.
Right, so that's a separate topic called presentation of financial statements, again. Right, that's a separate topic.
Okay.
Presentation of financial
Okay.
statements. So
Okay,
what
all right.
happens with that one? There are two main ways of combining an income statement and disclosing the items there. So one of them is what we are presenting now, which is the most popular one, right? But there is another method that can also be used to combine a statement. So what we'll do,
Hello.
for the purpose of preparing the financial statements, the one that we are doing now, we'll use this method.
329
Sorry, come again.
00
Right.
65
All right,
65.
let's meet good people if we have a conversation on the side. right? So that the class is smooth. You can unmute to make a comment and then mute again. Right, so we are going to have to do the topic of presentation to
Dạ,
show.
ra cái quả ai. Big say bitaw ko. Bosa sakay. Phew,
Let's
wala ka na sakay.
Right, so we are going to do the presentation of financial statements topic separately, where we are going to highlight that difference in terms of presentation. But we won't be using it here for the P&L account. It will be just for the purpose of learning also another alternative. We'll come back to that one. Right, let's continue. Right, so I've got a question here. This question, I think, is somewhere in your study guide. I picked it up from one of the tutorial letters. So it says here, the following is an extract from the trial balance of Goblet Limited as at 31 August of the year 2024. Right, then we are given the trial balance, ordinary shares, retained earnings, 12% redeemable preference share capital. Right, I'll come back to this. Very important information is to be derived from there. Right, motor vehicles at carrying amount, equipment, accumulated land, buildings, right, your normal trial balance. Then we have revenue, other income, other expenses, admin, sales returns, distribution, and profit on the sale of financial assets. Right, then we have Waplet maintained a gross profit percentage of 60% on the sales during the year. Right, then we are given the key personnel are as follows. Right, so this is basically just the information that we have. Right, and then we continue. It says on 1 December 2023, equipment with an original price. So we use this information for the calculation of depreciation. Right, then they give you a breakdown of the administration expenditures. Right, which are highlighted there. This is so that you can be able to compile the note. Remember, Tina, we're going to just disclose one line in terms of the administration expense. But when we do the note now, we need to highlight what makes up that note. So you have the details of what you must include there. Right, other income consists of the following. Again, you have got other income. Right, you will probably use this also for the purpose of your disclosure note on the profit before tax note. Right, then they continue and say the redeemable preference shares are redeemable on 31 December 2024 and is thus regarded as a liability by the company. Right, when you have a company, right, a company could have an issue different types of shares. Right, type of shares issued by a company. Right, we must be clear on the issue of shares. Right, we normally have two types here. Right, we have normally what is called ordinary shares. Right, we have what we call preference shares. Right, ordinary shares, these are classified as equity at any time. So this will always be classified as equity. Right, then we have the preference shares. These are classified as either equity or liabilities. Right, what do you understand by the term equity, good people? Right, equity normally represents the funds that have been used to fund the business that were provided by the shareholders of the company, who are the owners of the entity. So those are what we call shares usually. These are funds provided by what? By shareholders. Now, the ordinary shareholders are the true owners of the business. Right? They are funders of the business and they are true owners of the business. Right. The key thing now with equity and the ordinary shareholders is that the amount invested, right, the entity has no obligation to pay back. That's the key feature. Right. Remember, when you fund a business, you can either use your own money, even if you're a sole trader. If you use your own money, that is capital, then it goes into the business, right? Or you can use borrowed funds, which can be in the form of loans, bank loan, and what have you. Now, those amounts are also used to fund a business, but they don't belong to the owner, they are borrowed funds. So now the key with borrowed funds is that you have to pay them back at some point. If you have borrowed money, normally it comes with a repayment debt. So that particular amount is a liability because you are owing as an entity, you have to pay back. Now, that is not the same with equity. These funds, as an entity, you don't have to pay back because they come from the owner of the business. Now, when you have preference shares, right, usually preference shares can be classified into either redeemable or non-redeemable. Let's see what they said about these ones. These are redeemable, right? So what does that mean when it comes to shares? Right, so preference shares can be classified as follows. Right, we have redeemable, right? I think redeemable, I should have like that. Right, when they are redeemable like this, okay? When the preference shares are redeemable, right? So what it means is that these particular shares are similar to debt. We need to pay back the amount invested. Right, are we clear about that, good people? Right, we need to pay
Yes,
back the amount that has been invested by the shareholder. Now, because this amount must be paid back, it has got more commonality with a loan. It has got more commonality with debt. So therefore, we classify this as debt. Right, which means the dividend, right, paid to the shareholders is treated as interest in the P&L. Very important to remember that. Right, so when you remember, a loan pays interest, which is a finance cost. A normal share, for example, for ordinary share, we reward the shareholder by giving them a dividend. But a dividend is not an expense of the entity. It is therefore not accounted for via the P&L account. However, there is going to be a difference if we now treat the preference share as a loan because it is what redeemable, it has got a repayment debt. We don't treat it like an ordinary share. We treat it like a loan, which means the dividend being paid, it is converted or treated as interest in the P&L, and therefore it's going to go to finance costs, and we add it to any other interest that we have. Right, a preference share can be non-redeemable. Right, it can be non-redeemable. If it is non-redeemable, then we are saying that the amount invested by the shareholder is not payable back. Right, so no repayment of capital here to the shareholder. We don't have to pay the shareholder back. So therefore, we classify this as equity because that particular fact means that it is more similar to equity than debt. So we classify as equity. Right, which means the dividend is not a finance cost. Right, the dividend is not a finance cost, and will be accounted for in the statement of changes in equity. Right, so you need to make sure that you remember that. It's very important. It's going to gain more prominence in the third level modules. Right, you deal a lot with the redeemable preference shares and also the non-redeemable preference shares. So the foundation is here. Make sure you understand it. We normally have a problem with people not understanding this at that level. So please make sure that you understand the classification and also know what the impact is in the P&L account. Any question on this, good people? Are we clear? Right, are we there?
Yes, we are.
Yes, you are.
We're clear.
Yes, we are. Yes,
Thank you.
yes, yes.
Wonderful. So I was busy just explaining the information that I was reading right up to the end there. Let's continue. Then we have SA normal tax still must be provided. At this level, income tax is given to you. You don't calculate anything. This is an expense. It will go to the P&L under profit before tax. You will calculate this in FAC2701 in the next accounting module, but here this will always be given. Right, the credit losses written off in the previous 2 years amounted to, right, you are given this for disclosure. You don't have a line in your P&L that says credit losses. Right, then they say Goblet's land was revalued on 30 June by Mr. Lyon, a son appraiser, at a market value of 200,000. Right, this is revaluation surplus. Right, you have done it already in 2601. I will explain it when we get to this part as we are answering the question. Right, then the requirement, prepare the statement of profit and loss and other comprehensive income and the applicable notes thereof of G Limited for the financial year ended 31 August 2024. Your answer must comply with IFRS. Ignore the note on the accounting policy, comprehensive comparative figures, and the statement of changes in equity. So we don't have to compile the changes in equity for this one. Right, this was a past paper, by the way. And of course, the paper, your module was structured differently back then when they examined this, but look at the mark distribution. So statement of profit and loss, you need to make sure, right, because it's a significant portion of the syllabus. And in the exam, the final test or the exam that you are going to write, it is going to give you nothing less than 25 marks, which is at least a quarter or high of the syllabus. So you need to be very much 100% on top of this one. It's going to be there in the biggest assessment that you do at the end of the semester. Right. All right. Just I'll cover in passing what we already did, and then we continue so that anyone who was not here can follow. Right. Obviously, when you start your statement of profit and loss, you always start with what we call revenue. Right. Revenue is made up of usually the sales figure. Right. However, if there were then returns afterwards, right, the returns will reduce the amount of sales. So it's sales minus sales returns and then less any settlement discount that would have been offered to the entity. So we're looking at settlement discount granted. We deduct that. So if we then go to our question, we were given the amount of revenue, which is an amount of 9.4. So this is the figure that we were having here. Right, as we read through the question, we're looking for sales returns as well as settlement discount what? Granted by the entity. A discount reduces the invoice value. Right, revenue, remember, is sales which is made of invoices, so less any discount that you offer. So here we then saw that there was a sales return of 1.2, which we also accounted for. That's what gave us that figure of 8.2. It was sales returns. Right. Normally at this level, the question does not really require you to calculate cost of sales. Right. That was studied in the previous module, but it can still be required of you. Whatever you covered in the prior module, it is assumed knowledge here and can be examined. However, this question did not ask you to calculate the full calculation of cost of sales. This is what they gave you. Right, so if we go to the question note number 1, they then said, right, a Goblet maintained a gross profit percentage of 60% on the sales during the year. So they are telling you that the gross profit amount is 60% of the sales value. Right, I then mentioned again that when you express, right, when you express, right, gross profit as a percentage, right, of sales, we call this margin. So therefore, the figure that you were given here, 60%, that's a margin. So that 60% represents what we call a margin. Right, it simply says if we take the gross profit amount, we divide by the sales, right, then it's going to give us 60%. So in this question, I already have the sales figure, which is the one that I've calculated. You must use the adjusted amount, the final figure here, after removing sales returns. So I already have that. If I want the gross profit, I simply say 60% of the sales value, then I get the gross profit. Once you have the gross profit, you now say the cost of sales is the difference between this amount and the gross profit. The answer equals to cost of sales. Are we clear about that, good people? Are we understanding it?
Yes, I am. Thank you.
Wonderful.
Yes.
Right. In another question, alternatively, instead of saying the Goblet maintained a gross profit percentage of 60% or right on sales. Remember, they said Goblet maintained a gross profit of 60% on sales. They could have said 60% of cost. Now that's a different thing altogether. So now, if we express right gross profit right as a percentage of costs, this is called a markup. Right, so it is gross profit divided by cost of sales. Then you get your percentage. Right, so in other questions, they could have given you the cost of sales and the markup without the sales figure. Right, so in other words, the question could have already given you this amount. They would have told you that the cost of sales is 3280. Right, then they tell you that the gross profit percentage is a percentage of cost of sales and they give you the value. Right, so for example, if I calculate here and say, this one is going to be tricky, 4920 divided by 328, it gives you 150, so it will be 150%. Right, so in that question that we're doing now, this would have been 150%. So they would have said markup is 150%. So when they give you that, remember they would have given you already the cost of sales, which is 3280 there. So it means we would have alternatively have been given 3280 here and been given 50%. We would have simply multiplied that by 1.5. Then it would have given us the gross profit figure, right, which is 4920. Then to get the revenue, we would have said 4920, which is the gross profit, plus the cost of sales. We add the two, we were going to get that figure of 8.2 million. So you need to know how to maneuver depending on the information that you have in the question. Any question from the floor? Right, are we following?
Yes, we have no question from my side.
Wonderful. Hope everyone is following. So I'm just saying so because the next question may give you a gross profit on cost instead of sales. Then you will have to work backwards and get the revenue. Right, then we dealt with the other income. Right, which items, good people, did you say we include under other income in the previous session? Right, which items go in there? Right, remember income is anything that increases your profit for a particular period. So income includes such things as revenue, but the revenue is accounted for separately. It's on its own there. Then any other income that you receive, which is not revenue, it will go to other income. So if by any chance, let's say you receive the rental income, right, it will go there. If you invested your monies as a company and you received interest income, again, it will go there. If, for example, you earned dividend income, you invested your money as a company on the stock exchange and bought shares of another company, they will give you dividend income. Right? If you sell assets, sometimes you make a profit on sale of assets. Right? It will go there. And also sometimes you've got fair value gain. Right, we do not have this one in the question. Right, so however, if you were not there in the prior week, I would direct you to the previous lesson, right, so that you can see how we were going around the calculation of fair value. We did explain it in detail there. So it's not there on this one. I will not waste too much time, but you can go through the detailed explanation so that we move with the class from last week. Right, so these are the normal things that you deal with under the other income. Now, what you must look out for, usually if you have these things, they are already given and you don't need to calculate. Right, however, these two, sometimes they are not given and you need to go on the side and calculate them and then add them to your other income. So you need to go through the whole question and identify whether there was a profit on the sale of assets or not, and whether there was a fair value gain or not on intangible assets. Then you account for that. So in this question, it was actually very easy, right? Because we went to the question here, other expenses were given, or other income, sorry. So we had a figure of 82875. Right, we were given also a breakdown of what made up that figure, were we? Other income, we're not given. We were not given that breakup, but anyway, it's not very important. Right, we have it here. Right, other income consists of the following. Then we're given that list. If you add these things, they make up the 82. So we had some dividends income received, interest received, and there was a profit on the sale of a motor vehicle. Then, besides this, we were also given another profit, which is profit on the sale of other financial assets, right? We sold some of our shares, which is a financial asset, and we earned a profit of 40. So therefore, it was that total given plus the 40,000, then we got the 122. Right, I think that figure should be 75 then. Right, so this is where we ended in the previous session. Any questions before we continue? Right, hopefully we are clear. Right, then we looked at other expenses. Now remember, we're given already a total of other expenses here. Right, it says other expenses including depreciation. which is correct. Depreciation must be included together with what? Other expenses. If it has not yet been calculated and included there, you go and calculate depreciation on the side, and then you add it to the other expenses figure, which would be before depreciation. So here they said, including depreciation, the amount is 908. Normally, what you do with the question, you must check if there is any additional information in connection with other expenses, because some additional information may mean that you need to adjust the figure. So we go and check. We're given the key personal information, right? There is nothing specific on other expenses. So what it means is there is nothing that is important that you've got to worry about. Take the figure as it is, which is what we were having there. Right, we do the same with the administration expense. Right, so if we go to admin, we are given a figure, 750,000. There is nothing in the notes concerning this. So therefore, we are going to write it as it is. If there is something that needs to be adjusted, you will see by this having a note. I put it in the wrong place. I want, this is distribution expense. Right, then next, I want to deal with administration expense. Right, again, we have the administration expenses. The figure is 2491. Is there a disclosure in the notes? Right, the administration expense will encompass this note, which is information concerning the directors of the company, what they were paid, and the other perks that they got from the entity. Right, it will also include a breakdown of the salaries specifically paid to the what? To the directors. Now, this information that is for the directors, you are not being given that for changing the figure there. You are given that information always for the note that you are going to compile. So there is nothing that we are changing. As long as you see that the administrative expenses are affected by information on directors, don't change anything. So you take it as it is, and therefore we've got a figure of 2491 here, right, which we bring. So 2491,000. Right, then finally we go to the finance cost. Right, finance cost, if we check here, was there any financial costs that were given? Were we given any financial costs? Let's see. Right, we read going downwards there. Right, there is interest paid. Right, there is interest that was paid. I think I need to add these figures. Right, I'm going to add the credit losses, 130,000 plus 45,000 plus 2 million in salaries. This is the admin expenditure. We're given the admin expense here. Plus 46, we're given for disclosure, plus 220,000. What does it give me? Right, so when we go to this figure here, right, the figure of administration expenditure, it is inclusive of the finance cost. Can you see that, good people, in the question? Right?
Yes.
Yes.
What do we do concerning that? Right? What do we do concerning that, good people?
We need to adjust that amount.
Yes, the finance cost must be disclosed in a separate line on its own. Right? It cannot be included together with what? Right? With any other expense. You have to show it separate. So therefore, it means we've got to adjust our figure there because this figure included the finance cost there. Right? So I had not seen that properly. So, but when you now go to the disclosure of that note, you see that it includes interest on the loan. Right? So at all given times, the interest on the loan must be in a separate line. So therefore, we need to take this amount, 50,000, and disclose it separately, which means it must come here. Maybe we'll have more finance cost. I think we're going to have more. So what it means, that figure of 2491,000, it contains the finance cost, which must be shown separately. So therefore, if I now say 2491 minus 50, that should be 2441. So we need to make an adjustment here. Right? Any question, good people, on that adjustment? Are we understanding it?
Yes, understanding.
Right.
Yes, we are. I am.
Right. Let's look at the finance costs. Now, remember I said we are going to come back to this, which is the 15% redeemable preference shares, right, which are worth 400,000. Now, these preference shares, because they are redeemable, we are going to treat them, right, as a loan, which means the dividend that is payable on those preference shares is going to be treated as a finance cost. But you only do this if these are redeemable, and they emphasized here, right? They emphasized here that the redeemable preference shares are redeemable on 31 August and is thus regarded as a liability. A liability pays interest regardless of the name that it carries. So this is a liability. The dividend, we treat it as interest. Right. When you want to calculate the dividend on a preference share, right, you say how much is the value of the preference share amount borrowed, 400,000. What is the rate of interest, coupon interest attached to it? 15%. So you multiply by 15% here. So if we say 400,000 times 0.15, then we add the 50,000, which is the interest on the loan, we are going to have 110,000. And that represents the finance costs. Are we clear, good people?
Yes, clear.
Right,
Clear. Thank you.
wonderful. Gross profit 920 plus 122,875 minus 980,000 minus 2441,000 minus 750,000, right, minus 110,000. Then we are going to get a figure of 761,875. Now, this figure is what we call profit before tax. That's your profit before tax. Then you go to the information provided. You want the income tax expense. Sometimes it is shown on the trial balance, sometimes it is not. But the good thing is at this level, you don't calculate. You deal with income tax in that level. So here you just copy the figure as given. So the SA normal tax of 197,925 must still be provided for. Right, so we take that figure as it is given, right, and we deduct it from the profit before tax amount. Right, so we say 761,875 minus 197,925. We are going to get a value of 563,950, and we call that profit for the year. Right, to conclude the statement, we then look at what we call other comprehensive income. We want to look at other comprehensive income. Right, at this level, there are two things that you look at here. Two things that we need to take care of. Right, number one, we need to look at what is called the revaluation surplus. Right, this affects land, usually. We don't revalue depreciable assets, like your motor vehicles, your buildings, your equipment. Those are depreciable, so we don't revalue them. But when it comes to land, land can be revalued because it's a non-depreciable asset. Right? You see, when you buy a piece of land for 1 million, because we don't depreciate the land, the value of 1 million may remain in your books for a long time. But we are saying that the value of an asset like land, it is not consistent, does not always remain the same. It can fluctuate. It can increase, it can decrease, but usually land what? Appreciates in value. So if you now hold on to the piece of land for a period of 5 years, right? You bought it for 1 million in your books for the last 5 years, it was recorded as 1 million. You may find out after 5 years that a similar land in the same location that you are with a similar size is now going for 1.5. What does it tell you? Your land is now undervalued. So you are then allowed to revalue the property upwards. So you look for what is called the net realizable value of the property. You find your property is now worth 1.5. How do you find this value in the market? You look for similar sized land in the same locality, right, of the same condition as yours. You check what the market is saying. Right. If perhaps the market is saying the land is worth 1.6 million. But to sell the land, you have got to pay estate agents 100,000. The net realizable value is the net amount that you can derive from your land after paying off the expenses of disposal. So I just gave you one type of expense there, which is the agent fee. If you use agent to sell and they charge you 100,000. So it means that the land in your hands is actually worth 1.5. Then you say less the book value, the current value of the land in your books, which is 1 million. This amount here, the extra amount that you're going to add to your land, is called the revaluation surplus. So this amount is a gain by the entity and should be added to the profit before or profit for the year. You should add this amount. It's called the revaluation surplus. Right. The other amount that you add is what is called mark or mark to market reserve. Right. This is your fair value gain. Right. Through OCI. Right. Reference last week's session. Right. It's a long explanation. We will not finish the question if we start with this one. So what you will do is go back and visit last week's session. I explained this. If you don't have last week's session, I will share it in the evening today so that you can go through that and then you can look at the fair value gain through profit and loss. We don't have it in this particular question. Right. So these are the two things that you've got to contend with under the other income or other comprehensive income section. So when we go to the question, we then go to the information provided here at the bottom. Right, they were very clear on the land. Right, they said Coplet's land was revalued on 30 June 2024 by Mr. Lyon, a Son appraiser at a market value of 200,000. So this is the revalued amount. That's the revalued amount. They didn't mention any cost of sale. So therefore, you assume that we can realize the full 200,000 on the value of our land as of the current year. Right, but when we go to the information provided, right, we then see that the land is being shown at its original cost here. Right, so when you go to the land, the original cost of the land is 160. But we are saying in the market, we hired someone to do the revaluation for us and the value is 200. So therefore, it means there is a revaluation of land. 200,000 is the new value in our books. I will just, because all right, let me just remove that. I've already done my structure. This, or it's fine. Let's just show it like that. Let's show it like that. It's fine. So we have 160 there. So we then say 160 Right. So we say 160,000, which is going to give us 40,000. Then let's just change a little bit here on our presentation. Right. So that we can complete like this. Right. So what we then do, we then get a figure of which it is 40,000 here according to the calculation. So that's your revaluation surplus. You are going to add that. Right. So that is going to be added to the profit for the year. So that we say 563,950 plus 40,000. Then we're going to have 603,950 there. So that represents, right, our profit for the year. Any questions, good people? Or our total comprehensive income, actually. So this is called total comprehensive income. Right, this is our total comprehensive income. Right, any questions, good people? Are we clear? Are we understanding this?
Yes, I think you are
No
very
questions from my
clear.
side.
Wonderful. So this is your P&L. As you can see, if you're coming from the lower level, it's slightly different in terms of how we do things from the previous period or from the previous year, but we are still doing the same thing. It's the statement of profit and loss. Now, when you are here, you are not done. You now need a note. So we then say G Limited. I think it's Goblet Limited. And then you say notes for the year ended. Right, notes for the year ended. What is our year end? Right, 31 August of the year 2024. It's not 2024, it's 2024. Right, once you have that, normally I don't like to write note number one. Note number one is preserved for what we call the accounting policy note. So you start with note number two. However, sometimes here they start with note number two, sometimes they start with one. Doesn't really matter. So there is a note called the accounting policy note, which must always be number one, right? But they were very clear in the question, right? Under the requirements, right? Ignore the accounting policy note. So this is always the case. We don't do the accounting policy note, even up to that level. We don't worry about the accounting policy note, but we need the profit right before tax note. Right, the profit before tax note, we are highlighting important details concerning the summarized income and expenses that we highlighted in the note. So it has got two components. It has got the income side. So you say income, and then it has got the expense side. So you also need to show the expenditure as well. Right, so you don't disclose all items of income. There are selected items of income that you must show. Right, the first one is what we call revenue from sale of goods. Right, this is always your first line. So you must master the disclosure and you need to be able to account for that disclosure properly. But you always account for the revenue from the sale of goods. Then you have income from subsidiary. Right, I will explain this. Right, then you have income from other investments. Right, I'll jump a bit of space there. So income from subsidiary, you will need to highlight what the income was. So if you have got two items of income from the subsidiary, you will then have to show them line by line, right? And then you add them together. If there are three, you have to show them line by line, and then you add them together. Right, then we have income from other investments. Right, again, you may find that you have got one or two. You need to highlight each one in its own line, and then you must add and show a total. Right, we show profit on sale of assets. Right, we also show a fair value gain. Right, through P and L, if we have it. So these are the items that you need to show with regard to income. And then next you go to expenses. You must disclose relevant expenses. Right, so let's start with the income. Let's finish there first. Right, this one that you call revenue from sale of goods, you don't have to disclose anything complicated. You just show this amount. The final figure that you have under revenue, the 8.2. So you need to highlight that particular figure. It's a free mark. Remember in accounting how they mark. It doesn't matter if you calculated the incorrect figure here. Take that incorrect figure and you disclose it here. You have earned half a mark for knowing where that figure is disclosed, even if it is the incorrect amount. So that's a half mark that you are guaranteed in your exam. Whatever figure you have calculated, just disclose it there. Yes, ma'am.
I just want to ask something because I keep going back and I think maybe I got lost somewhere.
Mhm.
On the profit and loss, the one you just did, there are a few, yes, on that one there.
Mhm.
At the bottom there, you have add other comprehensive income. Is that 40,000?
That's 40,000, yes.
And then you have a total comprehensive income, another 40,000.
Right. This one, what happens? Remember, sometimes you can have maybe one or two items, ne?
Okay.
So you need to add them. This one will be the total now, ne? So let me.
Okay,
This is not clear.
because now if we, okay, yes, so then now that makes a bit of sense. If that one is not there.
Yes.
Because now if you add those 40, it becomes 80,000, then it won't be 603 now.
All right. It's only 40,000. It's only that there is one item.
140,000.
So that's the total. But if you're having two items, you're going to say whatever is here, whatever is there, you add, then you get the total.
Okay, so that total, okay, so the total comprehensive income, there, it's not there, it's right at the bottom, it's not in between there.
Right, which one? The total comprehensive income. Oh, here, ne?
You see what happens? Yes.
I
Because
made
now that's
a mistake.
confusing me.
I made a mistake. What was I doing there?
Okay, all right. Because now I was wondering how did you get them to 603 if they are
Should be
240?
like this, right? Thank you very much. So it's other
Okay.
comprehensive income there, ne? Then you
Okay.
have, I should have said revaluation surplus or just revaluation, ne?
Okay, yes.
Right, then this is the working there that we did, ne? So now, yeah, it's just the working. So this can
Okay.
come here now 200,000 like this, minus
Mhm.
160,000 there. Right,
Mhm.
then we can have our structure like that. So it should look something like that. That's better, ne?
Okay, but you still have 240,000.
Yes, it is because remember this one, this is a total,
Okay.
right? So it's just the style of presentation. And it normally we would be having two or three things here.
Okay, yes.
We add them up and have a total. This time, yes, we have an item, but we have tallied it up. So when we add now,
Or then it becomes a total at the bottom there.
we add this and that, and the answer
Yes.
was there.
Okay, all right. Okay.
Right?
All
But
right.
you still earn a mark for showing the calculation here. Ne?
Oh, okay.
You
All
need
right.
to include it like so.
Okay, all right. Okay.
Sharp.
All right. Now I get it because I was lost there.
No, at least you have helped there. The presentation was not very, it was suspect there. So we get it.
Okay.
Thank you.
All right. Thank you, sir.
Sharp. Right. Free mark revenue from sale of goods. You just take that amount there. It's a guaranteed free mark, good people. Even if you don't know what you are doing, get half a mark there. Because remember, I'm saying when accountants mark, they mark principle. You know what you are doing. Yes, you know that the revenue amount must be disclosed there, whatever the amount that you have. Just disclose it there. You get half a mark. Right. Once we have that, let's look at investments. Right, because this here represents investments, the income from investment and the income from a subsidiary. Right, so we are saying whenever we look at investments, you must get this right. It's always a problem for students when they get to that level there and you say investments, they don't have an idea what you're talking about. Right, when we talk about investments, a company can invest by giving out a loan. So a company can give a loan to. Right, a company can invest by investing in a fixed bank deposit. A company can invest by buying shares. So we have a share investment, meaning to say the company has bought shares in another company. Right, so all these three items represent possible investments that a company can make. Right, and then out of this investment, we have a portion of this investment that we call a investment in a subsidiary. Right. So when you talk about an investment in a subsidiary now, what is this thing doing now? Right. I want my lines. Right. Thank you. Right. When you talk about investment in a subsidiary, this comes from share investments. So when you have bought shares in another company, there is a possibility that the investment can be classified as an investment in a subsidiary. Not all investment in shares are an investment in a subsidiary. Now, an investment in a subsidiary is when, right, an investment in a subsidiary, right, is when an entity, right, acquires more than 50%, right, of the ordinary shares of the investee. Right, more than 50% of the ordinary shares. So we must be clear, ordinary shares, never preference shares. Right, and attains control. Right, and attains control of investee, meaning to say they now call the shots in that company. They have the majority of ownership. So therefore, they direct the company's affairs. Right, they are now the majority shareholder and they direct the affairs of that particular company. So we call that an investment, right, in a subsidiary. Now, let's be clear. Loan yields interest. A fixed deposit yields interest. Share investments yield dividend. Right, and also possible fair value gain. Right, I will deal with fair value gain in a question where it is there. This one does not have fair value gain. Right, so that therefore, when we now disclose here in our memo, we need to go to our shares and read and find out if we have got the majority shareholding of ordinary shares in one of our investment. Then that investment is called a subsidiary. Then we will look out and say, what did we receive during the year, which constitutes income, which came from the subsidiary? You disclose it separately. Then other investment, you will show them also in their own separate slot. So that is what we need to do. Are we clear? Any question? Right, let's go to the question. Right, first thing, sometimes you check here if they mention investment. Right, they did not show investment. Here I'm looking for when we buy shares, not when we issue shares. But we can see that there was a profit on the sale of financial asset. We must have shares. Then we go to the additional information so that we can see what they say concerning this. Right, so this is the information that we get in terms of other income. Right, so we then have dividend received. There were two companies that gave us dividend. There is Bobkin and then there is Sunbeck. Corporate owns 10% of shares in this listed company. So we only own 10% of the shares there. So that cannot be our subsidiary. Remember, a subsidiary is when you have got a controlling interest in that particular company. You have got more than 50% of the shares, which means you outvote everybody. Right here, they did not explain much, but on the one where we don't have control, they told you. So this one is not our subsidiary. This one, there is no information, but if they already highlighted the company where we don't have ownership, then this one, it means we have control because we are likely to be having more than what? 50%. It was important for them to tell you where you don't have control. So this company here is our subsidiary. And from them, we received 35,000 in dividends. So you disclose that. So you have to name it. It's dividend that we received. Right, 35,000. Right, there was no mention of anything else received from Poppy. Sunbeck is not our subsidiary. Right, so since Sunbeck is not our subsidiary, we received 20,000. You disclose it here. So you say dividend. Right, 20,000. This is our other investment, not a subsidiary. Then you continue and say, what else did you receive from your investment? Then we have interest received. Right, from our debtors, we received 15,000. Now, debtors is not investment, as per se. Here we are looking for long-term investment, non-current. Debtors is a current asset. So therefore, we are not accounting for the debt. Right, but we did receive interest from Sunbeck. Sunbeck is not our subsidiary. They paid us interest. So therefore, we're going to say income from other investment. We say interest. Right, then we have 10,000, which is going to give us a total of 30,000. This one, we did not receive interest, so we didn't give these guys a loan. You can only have interest if you gave your subsidiary a loan. It's not always given. So this is how you disclose income from investments. Any questions on that, good people? Are we clear?
Yeah, on my side.
All right. Hopefully everyone is on the same page. Now, if you made a profit from the sale of non-current assets, your PPE, or from the sale of your investments, you disclose that as well. We don't have to calculate, it was given. Right, profit on the sale of shares, 40,000. So we bring that. So we say profit on the sale of shares here. Right, it was a free mark here. It was given. Sometimes you calculate that on your own if it is not given. Right, then there was a profit on the sale of motor vehicle. profit on the sale of motor vehicle, it was given 2875. Right, in this question, there was no fair value gain. So not applicable, but in another question, you may find it. Right, go and check last week's session for detailed notes on this one. Right, other expenses. What do we disclose? Right here, we disclose a number of things. We disclose salaries. Right, sometimes we call that staff expenses or simple salaries. Right, we disclose the auditor's remuneration. Right, auditor's remuneration. Right, there are normally a number of items that make the auditor's remuneration. We disclose depreciation. If you have got a loss on disposal, right, you also show that. And then significant expenses. Right, there may be one or two other things that as we go along, we will be able to highlight. For example, if you have got a list, some certain lease expenses, you disclose them here, but you don't have it, and it's a long story, it needs a good lesson on its own on the list. So we'll deal with it when we get there. Right, then you go to your admin expense. There is a breakdown of what makes up that admin expense below. This is done for the disclosure. Part of that is salaries and wages, 2 million. That's staff expenses. So you disclose that in a separate line. Next, audit fees. Right, the auditor, fees paid to the auditor, we paid for two things, for traveling expense and for audit work done. So you say traveling, you indicate line by line here. Right, and also for the audit work. So you need to show exactly what the auditor was getting money for. For traveling, 46,000, you highlight the 46,000. Right, and then also 220,000 for the work done. So you have 220,000 for the work that was done by the entity. Then you add the two, you are sitting on 246,000 all in all. Right, loss on disposal, we do not have that, but we do have
Is it not 66?
right, yeah, saying 66. Yeah, it's 66 there. 66, thank you. Right, so that will be 66 there. Right, then on the significant expenses, we then have this particular one here, the allowance for credit losses. So you say allowance for credit losses, that you disclose again. Now, this thing called the allowance for credit losses, the expense is the movement. Right, the expense is your movement, which means you compare the current year's value with the prior year. So therefore, it will be your 15,000 here, right, less the amount of 14.3. Right, always for an allowance, expense the movement. Right, so which means we expense 700. Right, then this one you have got to calculate. This is depreciation. Right, so depreciation will always require a calculation most of the time at this level. Right, let's look at the information that we have with regard to the depreciation. Right, depreciation at this level is very important. You will always have significant marks to do with depreciation, either in the P&L itself or on the note for property, plant, and equipment. You can't make a mistake and go to the exam with question marks on the calculation of depreciation. Right, on depreciation, what do we have? Let's look at the assets. Right, so when you look at the trial balance here, I can see a couple of assets. Right, starting at the top with the motor vehicle. So I'm going to calculate first for the motor vehicle. Right, I don't think we'll finish the calculation here. It's a bit long, but we can finish for the motor vehicle. We've got 9 minutes. Right, for the motor vehicle, what information have been given? We have been given the motor vehicle at carrying amount, and this is the value at the end of the current year. Then we have been given the cost price and the accumulated depreciation. So what is this? Well, this is the carrying amount, which is the difference between these two amounts, right? Leaving me with 30,000. Right, then I want to go to the additional information. Right, where they say the following rates of depreciation, right, the following rates of depreciation are applicable. Motor vehicle, 25% straight line. And then they say on 28 February of the year 2024, a motor vehicle which originally cost 25,000 and on which depreciation of 21,875 has already been written off up to that date was traded in for 6,000 on a new vehicle with a cost price of 75. All the motor vehicles were purchased on 1 September. Right, so therefore, when we calculate depreciation, you need to separate your vehicles into the following. Right, you have the new vehicle, number one, the one that was bought in the current year. So that its depreciation must be done always separately. So we were told in the question, the new vehicle was bought at a cost price of 35,000, right, on 24 February. Right, remember on the day that we sold in the old vehicle, we traded in with a new vehicle worth 35. Right, the depreciation is using the straight line method. So what is the formula for the straight line method, good people? Right, straight line method, what is the formula? Right, it's the cost price of the assets multiplied by the rate. So in which the rate is 25 for motor vehicle, so we multiply by 25%. Then the answer that we get, we multiply by the number of months that the asset was used for in the current year. Right, this particular vehicle was acquired on 28th February, and our year ended in August. So therefore, we say March, April, May, June, July, August. So therefore, the asset was only used for 6 months in the current year, and that will give us the depreciation amount. 35,000 times 0.25 divided by 2, so that gives us 4,375. Any questions, good people, on that calculation? Are we clear?
I think for me, this is where I sometimes confuse things, especially when it comes to the dates, because it's if you look at the note itself, at some point it says all these vehicles were purchased 1st September 2000 and yeah, all motor vehicles were purchased on the 1st of September 2000.
All right, let's read that one. Right, on 28 February 2024, a motor vehicle which originally cost 25 and on which depreciation of 21,875 had already been written off up to that date was traded in for 6,000 on a new vehicle with a cost price of 35. So we are very clear. We sold the old vehicle on 28 February of the year 2024. And we immediately traded it in with that vehicle for 35. So now what they are talking about here, all the motor vehicles were purchased on 1 September. They are talking about what? The old vehicles. Yeah, the wording is a little bit tricky there. But they
Okay.
are talking about what? The old vehicles. Then
So
what?
our focus then, oh, sorry to cut you. So our focus is mainly on what happened in the current year.
Well, here, remember now I know that we had vehicles. Then in the current year, we sold one, which we traded in for 6,000, and we received another vehicle. So what I know is that I need to categorize my vehicles into three. Right, there is the one that we bought now, which is the new. There is the one that we sold, the one that we traded in, and then there is the old, which is the remaining motor vehicles. So first
Oh,
things
okay.
first, you must recognize that you have got three classes of vehicles here: the new,
Okay.
old, and the sold. Right, then on the new vehicle, what is important is to remember when it was acquired. So sometimes you can always do a timeline here, right, and say 31 August of the year 2024. The year starts on 1 September of the year 2023. Then you say 1 September, which is bang in the middle of the year, 28 February of the year 2024. You count your number of months here. So this is 6 months. This is 6 months. And now at this point, this is when you acquired the new and you sold the old vehicle. So once we have that, all we need to do now is to know which method we are using and apply it, right? Which is what we're calculating. The new vehicle cost 35. We are using the straight line method. It means the 25% must be applied on the cost price. But the vehicle was only bought in the middle of the year, which means it was used for only 6 months. So we've got to allocate or prorate the depreciation according to the number of months.
Understood.
Wonderful. Then we go to the old vehicle. Now, on the old vehicle, you are right in saying we are calculating depreciation specifically for the current year. That's what we want to disclose. So we then say, what was the cost price of this vehicle? 25,000 Rand. Right, depreciation is a 25% straight line method. But this one was also used only for half year. Then it was disposed. So 25,000 times 0.25 divided by 2. So the depreciation is 3,125. Then, sorry. I made a mistake here. This is the sold. This is the sold vehicle. Then I want the old, the remaining vehicle, the old vehicle that was there at the beginning of the year that was never sold. How do we deal with that one? Right, we need to go back to the trial balance. The first thing that you check here, right, has depreciation already been accounted for? The answer is a big yes, because they say other expenses include depreciation. So our figures here, they've taken into account the changes in our motor vehicle during the year. But we must be careful. What is this value? This is the carrying amount at the end of, this is the carrying amount on the day that we sold the old vehicle. Right, if I go to the cost price there, 239,200 minus 208,575. Then I'll get that. You know, the question that we must ask here is the 239,200, have we removed the sold asset from there? Or have we added the new asset that we acquired? That's what we need to find out. Now, the answer to that is very simple. Right, we are being given the carrying amount of the asset, right, on this date. This is the date that the old asset had been sold and the new asset had been replaced. So therefore, we can already assume that this figure is already devoid of the sold asset. It has been removed because we've already reached that date. But we have added already the new asset because we are at the end of the day, after which we would have already bought the new asset. So therefore, the 239,200 here, it includes the new asset that we acquired because of the debt multiplied by 25%. Let's remove that asset because we already have its depreciation there. Right, good people, are we following on that?
I'm a bit lost there.
All right, so let's do a timeline on that one. Right, we have our timeline. We have 31 August of the year 2024. Right, we have 1 September of the year 2023. This is the beginning of the year. This is the end of the year. I want to look at the cost of the asset. Right, then we have the middle of the year, which is 28 February of the year 2024. Now the question is, what happened here?
We sold a vehicle. We traded in a vehicle.
Yes, we sold a vehicle and then we acquired a vehicle. So what we are saying, from the value that we're having at the beginning of the year, remember here we'll be having only the old vehicle before any changes, or we'll be having the old vehicle inclusive of the what? Of the vehicle that we eventually sold. So we are saying here, whatever value that we're having here, we removed the sold vehicle, then we added the new, then we got that value there. So that value is the 239,200. This is the value that we have. So to arrive at that value, whatever value that I was having at the beginning of the year, I removed the sold vehicle, I added the new vehicle, then I'm now having 39,200. Are we clear?
Yes, I'm still with you.
All right, so I'm saying so and assuming as such because I already have this date here. Right, they were very deliberate. They gave you the motor vehicle at its carrying amount on that day, which is the date of sale. So it means at that date, we would have already acknowledged by deducting the vehicle sold and acknowledged the new vehicle by adding it. So therefore, we are saying this amount here includes the asset with a value of 35. It's included there. But that one, I have already calculated depreciation for separately. And this amount does not include the vehicle sold. I would have already removed it. So what I don't want from this figure is the 35 because I've already calculated its depreciation. If I leave it there, it will be double counting. All right, do you understand it?
Yeah, get it.
All right, so we then calculate our depreciation and then we get our total for the motor vehicle. The other guys, you are very quiet. Any question?
So there won't be any months.
Right, this one, remember, the one that we are calculating for now is the old vehicle. It was there from the beginning of the year right up to the end of the year. So no months there.
Okay,
It was
yeah,
there at the
makes sense.
beginning.
Makes sense.
So we don't prorate that one. But the other two, they were only used for half year. That's why we are prorating them. So that will give you your depreciation for motor vehicle. Right.
But quick question.
Yes, sir.
Sorry to cut you there again. Quick
Okay.
question.
Mhm.
So the 35,000, isn't that the amount for the new vehicle
It's for the new
that
vehicle.
we purchased?
It's for the new
So
vehicle.
then, isn't 25,000 the amount for the old vehicle that we sold?
25%, remember, is the depreciation amount for a full year, and for all the vehicles.
No, I mean like because for old vehicle, where we say old, it seems as if we took out the amount for the new vehicle.
Yes, 100%. We have taken that one out.
Oh, okay.
Yes. So you see what is happening. I want to isolate the old vehicle on its own. The reason why I'm isolating it is because I don't have to multiply this by what? 25. But this one, the new vehicle, I must multiply by 25. So I can't calculate the two combined. I have to split them. So I then take the combined value of the two vehicles. This value combines, it has got the 35 and whatever it is, that is the old vehicle. The old vehicle here is 239, 200 minus 35. So 204 is the value of the old vehicle. But the 35 combines this amount and that amount. I need to split them for the purpose of calculating depreciation.
Okay.
Right? Because this one needs what? 6/12. This one does not. So I can't combine the calculation. It's impossible. Ne? Right. So that is
Yeah.
how we calculate that. Right. I will probably have to check your study material for this semester. Right. So that